Hey everyone, welcome back to the channel. If you're watching this, you're probably thinking about buying a home or investment property in Israel, and you want to know exactly how much the bank is willing to lend you in a mortgage. In a previous video, I broke down the two big things banks look at in determining how much they'll lend you: your LTV or loan to value bracket and your net income. As I explained, the bank will lend you the lower of what your LTV allows or what your income supports. So even if you qualify for 75% LTV, if your income only supports 60%, guess what? You're getting 60%. So it's important to understand the income side, and today we're taking a deep dive into the income side. First things first, what counts as income in the bank's eyes? It has to be on the books, documented income. Pay slips if you're employed, or proper financials if you're self-employed or independent. Active income, passive income, both work. Rental income, yes. Government benefits like Social Security, absolutely. Pension payments, qualifying lifetime annuities with steady payouts, they count too. But here's an important disclaimer, and I need you to hear this. Every file is subjective. While these types of income are generally accepted, your specific documents have to pass the bank's review. Never assume until they approve it, okay? Good. Now, what the banks look at is your income net of taxes, and then they subtract your existing monthly debt payments from that. They want your clean monthly net income number. So, if you're salaried, your pay slips show the income net of taxes. If you're self-employed, you'll need an accountant's letter with the current year's net numbers. Reasonable estimates are often fine if you don't have exact numbers. They'll also require your previous, usually 2 years of tax returns. Once they have that monthly net figure, they'll look at your current loans and deduct those monthly payments as I explained before. The resulting number is what they use to calculate your mortgage. Here's the golden rule, and I'm going to start with this for clarity and then modify it a bit, so bear with me. The bank essentially wants your mortgage repayment to be around 1/3 of your monthly net income. Let me give you a simple example so it clicks. Imagine your monthly net income is 3,000 shekel. So with the 1/3 formula, the bank will allow a monthly mortgage repayment of up to 1/3 or 1,000 shekel. Saying in another way, that's 33% of the monthly income of 3,000 shekel. At an interest rate of, let's say, 5% for 30 years, that 1,000 shekel repayment gets you roughly around 200,000 shekel as a mortgage. But here's the better news. The banks usually go higher than 1/3 or 33%. I only use the 1/3 because it's a simple baseline to introduce the concept for the first time. In fact, depending on your full profile, banks can go up to 40% of your net income. That's the max, but as I've explained, it's all subjective to the individual person and situation, and the bank will not always go to 40% for everyone. So for safe planning, I suggest calculating with 38%. So now that we understand this a bit clearer, let's go back to the example with the same 3,000 shekel net income, but this time calculating with 38%. So 38% of 3,000 comes to 1,140 shekel as a monthly payment, which opens the door now to a mortgage of around 215,000 shekel. So in a nutshell, that's how the banks calculate it. I hope you follow the dynamic. Now, separate from the calculation, the bank will want to see stability, usually at least 3 months of pay slips, and sometimes an employment contract if you're new. They care about current ongoing cash flow. Future job offers or jobs accepted but not started doesn't count. A fat bank account with no regular income, still a problem. Cash flow is king. No cash flow, no mortgage, period. But don't panic if your situation is unique. That's actually not the end of the story. Real estate investors or business owners often have tax returns that show lower income than what they actually take home because of legal deductions, legal losses, and other legal accounting tricks. The Israeli banks know and understand this. A clear accountant letter explaining the real cash flow usually suffices. What if you don't have strong income? A family member co-signing can help. For retirees, Social Security and pensions count, as I mentioned. But there are also reverse mortgage style solutions available for those age 60 plus and sometimes even 55 plus. They're not as scary as the name sounds here in Israel. In fact, they don't generally function the same as they do in other countries and can operate almost like a regular mortgage. I'll do a full dedicated video on this soon because it's a game changer for many. There are tons of individual situations. This video covers the core framework, but every case has its own twist. That's why working with an experienced mortgage broker who knows the ins and outs can save you time, stress, and get you the best loan for your situation. If you're serious about buying property, understand these income rules early. They directly impact how much home you can afford and which deals make sense. Drop your questions in the comments. What's your situation? Salaried, self-employed, retiree? I read them all. If you want personalized help, my email is in the description. If this helped you, hit the like button, subscribe, and turn on notifications so you don't miss the next one. We're breaking down the entire mortgage process step by step. You've got this. I'll see you in the next one.